Yes, Mr. Ragesh, NRIs should use ITR 2 and onwards. Atul has a very interesting question when to download AIS, TIS, etc. So, AIS and TIS can be downloaded at any point in time from the income tax portal. However, the ideal time or the perfect time to download AIS and TIS with respect to your return filing is the day you decide to go ahead and file your return. Make sure you have the latest and the most recent AIS, TIS. If you have downloaded your AIS or TIS, let's say on 11th of June 2025, but you decide to go ahead and file your ITR on 20th June, then make sure you go ahead and download your AIS, TIS once more on 20th June. All right, I think we have sufficient participants. Let me quickly share my screen. All right, can I please have a show of hands or a thumbs up if you're able to see my screen? All right, all right. Thank you so much. So today I also have my colleague Divnay with me, who will go ahead and take up the second leg of today's webinar, wherein we will also talk to you about, as I mentioned earlier, the importance of tax planning for the current financial year with the changes brought about by budget 2024, then changes in budget 2025 which have a direct impact on financial year 25-26. It is very very important that we go ahead and also plan for the current financial year apart from filing the taxes. Both are very very important. So the second leg of webinar, my colleague Divnay will take over and help you understand the importance of planning for the current year, while in the first leg I will go ahead and talk to you about the changes to the ITR, changes brought about by budget 2024 and the impact on assessment year 25-26 filing. And then in the last leg of today's webinar, that is the third leg, we will then take up all the questions that you are having with respect to ITR filing, changes, budget, etc. So I hope the tone for today's webinar is set. So without much ado, let's begin. First and foremost, the agenda, as I've already told, is to understand all about the changes, the compliance requirements, the document checklist, etc. So first and foremost, let us talk about the broad changes brought about in all the ITRs for assessment year 25-26. As you must be reading about this day in day out in newspapers, and also all the tax blogs that you may be reading, there are a lot of disclosure requirements now introduced in all the ITR forms from applicable for individuals, ITR 1 to ITR 4. Most importantly, reporting of gains on sale of listed equity shares or equity oriented mutual funds must be made now. All right, and if you have these listed gains, you can go ahead and file ITR 1 or 4. That is to say, the base of ITR 1 and 4 has now been expanded. Then if you're somebody who's considering opting for the old tax regime, or the old tax regime is beneficial for you, for the filing for assessment year 25-26, there is detailed reporting requirement for deductions and exemptions. Now, what is this detailed reporting requirement? Why has this been brought into place? What are the implications? We will discuss later on. Then, when it comes to ITR 2 and 3, first and foremost, when it comes to capital gain transaction for financial year 24-25, now a segregated reporting requirement has come up, wherein any transaction or any sale of capital asset before 23rd July 2024 must be reported separately, and anything on or after 23rd July 2024 must be reported separately. Now, the reason for doing this is because from 23rd July 2024 onwards, there were significant changes made to both the holding period requirement and also the rates of taxes for capital gains, because of which this segregation is now more important than ever. Lastly, when it comes to ITR 2 and 3, asset and liability reporting is now mandatory only when the total income or the taxable income exceeds rupees 1 crore. Until last year, this reporting requirement was when your income exceeds rupees 50 lakhs. Now, let us talk about a few common points which are applicable across ITR 1 to 4. First and foremost, acknowledgement number of any income tax forms that you're submitting must be reported in the ITR. Now, you may wonder what are these income tax forms that we are talking about. So, there are certain forms, for example, Form 67 if you want to claim foreign tax credit, Form 10IA if you want to go ahead and claim certain deductions, Form 10E if you want to claim relief under Section 89. These are examples of forms that you have to file before filing your ITR. So, if you are required to go ahead and file any of these forms, then this year onwards, it is mandatory for you to go ahead and enter the acknowledgement number of these forms in your ITR. Now, the reason for doing so is there was a trend that we've been seeing year after year. Individuals often tend to forget filing these forms, whether it is Form 10 IE, a Form 67, etc., to ensure that the users have not forgotten to go ahead and file these forms. Entering the acknowledgement number has now been made mandatory. The second common change is quoting of Aadhaar number is now mandatory in your ITRs. You cannot go ahead and proceed with the ITR filing only on the basis of the enrollment ID. Moving on, now let us analyze in detail what are the additional compliances for the old tax regime. As I mentioned, if you're a user wanting to file your return of income under the old tax regime for assessment year 25-26, there is a detailed and minute disclosure requirement. So what are these changes and what are the data, or what are all the details to be entered in your ITR form? Let's understand. First and foremost, house rent allowance. Now, house rent allowance is a very common component of all our salaries, and a majority of us claim house rent allowance. Now, all these years, if we were to claim house rent allowance, going ahead and only entering the value of the house rent allowance exempt would suffice. But this year onwards, there are additional details to be entered. And please remember, these additional details are mandatory even though your HRA allowance has been reported exempt in your Form 16. This year onwards, an entry in Form 16 alone will not suffice. In addition to that, you have to go ahead and give out these details. First and foremost, the place of work. This refers to the geographical area where you're working. Then details of basic salary, the actual amount of HRA that you're receiving as part of your salary, and the rent that you pay. These are all the details to be entered, and the ITR utility itself will auto calculate HRA. Next, talking about ATC investments. Now, we are all aware that under the old regime, if you're opting for ATC, you can go ahead and claim in deduction of up to rupees 1.5 lakh. Now, this deduction can be claimed for various investments such as FD deposit, LIC premium, NPS investments, etc. PF investments, etc. So now we will have to go ahead and enter these details. For example, if you have taken a policy, that is a life insurance policy, you will have to enter the policy number. And if there are any other deductions that you have taken, then you will have to enter the document identification number. For example, if you have invested in FDs, each FD will have a distinct FD ID or a document number. You will have to enter that. If you have made a contribution to public provident fund, in that case you will have to go ahead and enter the document ID. So these are all the details you will have to enter. Next, talking about 80D, which is deduction for medical insurance. If you have taken a medical insurance, then you need to go ahead and disclose the name of the insurer along with the policy number. If you have taken an education loan or a housing loan, the reporting requirement is more intense. You will have to enter details of the bank name, the loan account number, the date on which the loan was sanctioned, the loan amount, and the outstanding balance as on the year ending. So, for example, for financial year 24-25, you will have to enter the outstanding balance as on 31st March 2025. Next, talking about deductions under Section 80DD, DDB, and 80U. These are all sections dealing with specified diseases or disability. So, in this case, you will have to go ahead and mention the name of the specified disease, the nature of disability, and also the acknowledgement number of Form 10IA. If you remember, a few minutes ago, I did speak about, entering acknowledgement number of various ITR forms you may be required to file. So this is one such example. If you do not enter the acknowledgement number of the file form 10IA, you will not be able to proceed with filing your return of income. Now, let us quickly spend a few seconds to understand why is the reporting requirement made so stringent? Why are so many details required? The reason is very simple. The IT department or the income tax department wants to go ahead and curb all the tax evasion loopholes that have been exploited so far. All these years, individuals would enter a flat amount, but now to go ahead and curb all this, to make sure that all the deductions are substantiated, the IT department has made this disclosure requirement mandatory. Now, this is an example. So, we have taken a home loan certificate from SBI, and again, these are all the details you will be required to submit. For example, the name of the lender is SBI, the loan account number is home loan account number given here, the date of sanction will be the original date on which it was given. So in this case, it is 18th November 2017. Then the total loan value, then interest component. So this is the interest that you have paid for the year, which is 5,97,329, and then the closing balance on 31st March. So you will get all the details in this document itself. Next, talking about education loan certificate. So here, once again, the bank name, the loan account number, the loan amount, the sanction date, and outstanding balance. Once again, you will get all the details in the document itself. You just need to take a look at this document and go ahead and submit this. Now let us talk about long-term capital gains and ITR. As I mentioned earlier on, individuals can now go ahead and report long-term capital gains in their ITR 1 and 4 as well. Now, historically, capital gains could be reported only in ITR 2 and 3 because ITR 1 and 4 were the simpler forms. But now, to widen the user base, the forms have been simplified, especially for users who fall under ITR 1 or who have been falling under ITR 1 or 4 for these past few years. So now, going forward, long term capital gains from equity, listed equity or equity oriented mutual funds will be able to continue to file ITR 1 and ITR 4 as applicable if your long term gains are up to rupees 1.25 lakhs. However, if your LTCG is above 1.25 lakh, or you have a combination of LTCG and STCG, in that case, ITR 2 and 3 will remain your best friends. You will not be able to file ITR 1 or 4. Now, this is with respect to gains. What happens if you have a loss? In case you have a loss from long term capital gain or short term capital transaction, and if such loss requires reporting, then you will have to stick to ITR 2 and 3. And if for the current year there are no capital losses, only gains, but if you have any losses from the previous year, then once again you will have to file ITR 2 and 3 alone. Please remember, as a thumb rule, whenever there is any kind of a loss, ITR 1 and 4 will be prohibited. ITR 1 and 4 will be applicable only when there is absolute gain, and this gain must be exclusively long term capital gain up to rupees 1.25 lakhs. Now, let us take a look at the ITR forms for assessment year 25-26. With these changes, there are certain impacts. Let us understand who will now file ITR 1 in light of all the changes that we've discussed. ITR 1 will be filed when income is less than rupees 50 lakhs. Now, what are all the income streams? The income streams are salary, pension, income from one house property, income from other sources such as dividend, interest, etc., and LTCG up to rupees 1.25 lakhs. Once again, please remember this long term gain must be exclusively from listed shares and equity oriented mutual funds alone. If you have long term capital gains, let us say from sale of house property or sale of any other capital asset, you cannot file ITR 1. You will have to shift to either ITR 2 or ITR 3. Now, third July 2024, the period of holding will continue 2 years and the applicable rate of tax will be 20%. For other capital asset, the holding period was under 3 years. However, post the budget changes, the 3 year holding period has been completely removed, and on a lot of these short term capital assets will now be taxed in their slab rates. Now let us talk about long-term capital gains. Long-term capital gains, again, there have been significant changes with respect to the holding period criteria and also the tax rates. First and foremost, with respect to listed equity shares or equity oriented mutual funds, if you hold them for more than 1 year, they will be categorized as long term capital assets. Up to 22nd July, the rate was 10%. After on or after 23rd July, the revised tax rates are 12.5% on gain exceeding rupees 1.25 lakh. That is to say, the earlier exemption was on income up to 1 lakh, but on or after 23rd July, it is 1.25 lakh. Now, when it comes to land, building, or unlisted equity share, the holding period criteria is over 2 years. So in this case, the tax rates up to 22nd July 2024 were 20% with indexation. And while the holding period continues to be the same, on or after 23rd July 2024, the applicable rate of tax will be 12.5% without indexation. Now, the most important thing to note here is that indexation benefit has been removed after Budget 2024 changes. The only thing here is that if you have made any purchase before 23rd July 2024, indexation benefit will continue to apply. Where the purchase is made on or after 23rd July 2024 onwards, there will not be any indexation benefits. Any other capital, any other capital assets where the period of holding was 3 years, now that has been removed completely. The 3 year criteria has now come down to 2 years. Wherever the earlier rate was 20% with indexation, that has now been revised to 12.5% without indexation. So, with this, we come to an end of leg one of today's webinar, wherein we have gone ahead and analyzed significant changes with respect to budget, with respect to capital gains, and their impact on the current year filing. Now, for leg two, I will request or I will invite over my colleague Divne, who will talk to you about the importance of tax planning for the current financial year, which is financial year beginning 1st April 2025 onwards, and how it is very important for you to go ahead and plan for it now, because these changes that we are discussing now will have a long term impact. These changes are not restricted only to your filing, which will end on 15 September. And for the last year, the transactions are done. But this year, we are still in quarter one. We still have a good 9 months ahead of us to go ahead and plan our financial health and also our tax health for the year. So, again, we have Divnay who will go ahead and share his 2 cents on this matter. Welcome aboard, Divnay, and over to you.
Thank you, Megha, for the welcome. And good evening, everyone. Nice to see such an interactive webinar taken up by Meba and the complete team of ClearTax trying to answer all the queries. So, the most important thing which I've understood through all these conversations which is happening on the chat, is it from Mr. Chandra that which ITR should I select from salary plus consult income, wherein Mr. Suresh bothered about grandfathering of mutual fund redemption, because the most important thing is there are two things in grandfathering, which is that before 2018 Jan 31st, there whatever is the actual price or the higher of the I would say the fair market value, so that you can save your capital gains over there, wherein Mr. Subodh Sharma trying to understand that do I have to pay advance tax even if it my 1.5 lakhs of capital gains is till 15th of June. But then you are also worried that there are two types of penalty in advance tax, that if I happen to have a lot of capital gains, if the market increases and my total other income, what should I do for my advance tax payment? Again, when I see Mr. Aditya Chandak worried about previous foreign tax credit claims which the date has passed and some exemption which he has missed, and somebody worried about the new types of the changes that has happened in the ITR forms. It is like what is to be needed to be given for contribution to PPF. I think it's Mr. Chandra or Miss Chandra, so that that if I put my PPF account number or is it the transaction number, that will give me the exemption? Will I get notice when? I mean, by putting the transaction number or by putting the account number? I see there's so much of confusion here. And also, Mr. Shashikant, who has been worried about that, okay, which ITR to be selected if they're selected for NRIs having LTCG less than 1.25 lakhs. Again, it's a valid question because there's so much of confusion that has been created, that okay, with LTCG less than 1.25 and above 1.25 with carry forward losses, without carry forward losses, my salary less than 50 lakh, greater than 50 lakhs, type of this. So that is the reason I see there is a significant amount of energy across the webinar, and I am very happy to see that you guys have trusted upon clear tax for all these. And I think fairly the tax expert team, which is also part of this webinar, trying to answer all your questions, and maybe will be answering all the questions in this particular set of webinar. And that's the true objective or the true mission and motto of clear tax, that we want to make sure that we give value to each of our customers so that they don't miss out on getting the every money which they deserve. And that's practically very important. And that's the reason, as a clear tax, as a company, we have understood that you need a right guidance in terms of your tax filing, in terms of your tax saving, in terms of your tax planning, and also paying the right due taxes to the government for the nation building. So, and I'm thankful to all these taxpayers who are here actively planning their taxes, and thank you for this. So the next thing which is most important for tax planning is that having a right tax consultant. And that's where I think we have a lot of questions before selecting a tax consultant or a tax expert who can help you solve through this. We are trying to answer as many questions, but this doesn't solve your use case. We may give you an answer that okay, up to 15 June your capital gains is 1.25 lakhs. Apparently you happen to sell more stocks or you get more income, then you would be liable to pay advance tax in future. And if you forget to or miss to do that, this year the tax filing has been delayed significantly. The interest on that just keeps getting adding up at 1% every month on month. And that's the reason we have listed on a lot of questions you guys must be having in your mind. Where do I get a good tax expert? Which I think most of you who are here in webinar have got the answer, that it is clear tax. That's why you are trusting us with our questions. How do I know what is a right fit for my situation? Which, when, okay, will they actually spend enough time with me? Because when the tax season reaches its peak, I see that most of the tax experts, they generally just give it to some intern or a lower I mean, or a interning tax expert within their segment, or they may not be giving the right amount of time or right amount of consultation, because it's all about the time. What do I feel? What if I don't feel confident while the tax expert I'm assigned with? Obviously, many of you would have migrated from various multiple other cities of the country, must have gone to some metro or some other region. You might not be having a comfortable position getting a right tax expert within your region. So you might not be confident about them. Will they just do what I tell them, or they'll suggest how do I save taxes more? That's also very complicated, because many a times many tax experts do not take risk. They also have this thought process of, what if notice comes, I will have to again handle this problem statement. ITD has made tax filing validation very stringent, and it has also become real time, and many a times it has become retrospective. They are trying to gather a lot of data and intelligence from the various source, and they are trying to rematch your data. You could see the recent notices which people have received for the last year set of this thing. Even I had received a notice 4 years back for a savings account which was just having an interest of 10 rupees with a 10 rupees mismatch of income. How do I know they don't miss something? How do I share? So this is what is very important. And that's why what we did this year is, though we were solving everything for you with our DIY product, wherein when you go in, just put your PAN, we fetch everything from your AIS and 26 AS and make sure all your data is there. But there are a lot of things in which you can do to save taxes. And many must be feeling that, okay, till 12.5 lakhs, if it is there, I may not be saving much of the taxes. Let me go for new. We will demystify all these myths in this particular webinar. So that's the reason we heard you all, and we launched something, clear tax expert assistance. And what do you get in this? Well, you get tax experts. They are curated top tax experts of India. They are vetted by clear tax 72 checkpoints. So here what we as a product have done is that we make sure that whatever is the type of your income which you have, when you just select a tax expert, we make sure the tax expert selected is an experienced, highly rated tax expert given to you. So you don't have to sit and search across the Google reviews of different tax experts in your location or in your hometown location, or trust someone who may be good for someone else, but you may have very complex questions like, okay, I had one prize winning in particular other country, or I may have only pension and FD income, and someone who has referred you a tax expert is very specialized only in for salary income. So what we do is we make sure that whatever type of your income is, we match those tax experts. And it's not that we only tell you you go ahead with this tax experts, we give you an independence. Out of 10 other tax experts matched as per your income profile, and you can switch and select whichever tax expert you want. So just imagine you happen to select a tax expert, you go there, you find he is not great, nobody is going to give refund. But here you get an option, okay, this tax expert is not working out, let me change over. This is something which I did not look forward for. The second most important thing which we understood as a pain point is that it is very important that you get video consultation for any uh, of your filing related queries. You might be submitting all the documents to the tax expert, but does he explain you that what is the total outstanding tax you have? Why are you being paid that so much interest? Why have you been planning a little bit of tax but you're not getting so high refund because there was some advance tax that was to be paid earlier? If you are an NRI, you may not be sure what all type of forms I have to fill. If you are in old regime, you will have to fill a lot of other details, which is to be filled in within the tax filing process. And certain requires you to even fill some forms. Certain set of deductions requires you to even fill up some forms and then put that forms acknowledgement number while filing the taxes. So this makes it very complicated. And the other uncertainty which you would be having is that how long will the tax expert take for filing my taxes? So we made sure that we make a process at ClearTax that once the documents are received, a tax expert has to dedicatedly allocate next 24 hours working on your particular ITR filing and close your ITR filing, because we understand the priority, the criticality. When you have done your work with respect to document submission, understanding what all you have to give with our relationship manager, why should you even wait? Within next 24 hours your filing should be done. And the most important thing is that most tax filings are very transactional. And what we did is we added a leg of responsibility, expert powered by tax, that they will help you with tax planning and your tax saving, your advanced tax planning, any future notices which comes in throughout the year once you have taken up a plan. So the person whom you hire, he is a video call away. You got some notice, he will solve it for you. You are confused that I have to pay advance tax now, he will solve it for you. You are confused, I will have to this is a capital gains, should I sell my stocks now, should I take section 54F now or not? He will help you for you. Any kind of advisory, should I do this now, should I do this later, should I pay this advance tax now, should I keep this money right away now, or I can optimize my cash flow, this tax expert is there for you because he has done your ITR filing, he knows what you have done. last year. The most important thing is notices. These days, a person doesn't get one notice based on the data, the type of data getting collected this year. A lot of notices could be anticipated because some kind of documentation requires some kind of a transaction ID, some kind of documentation requires that you take carry forward losses or you do not take carry forward losses. So all these things put in together leads to a lot of confusions and some kind of wrong information or some kind of an saving account. For example, you might have opened a Paytm bank savings account, which is no more allowed to do, but you would have got some interest over there. And that is somehow 1,000 rupees balance left over there. Paytm can goes and report that every month you are getting 3 rupees interest, and that 3 rupees interest is not being come into a not has come into AIS because you have not done your KYC in your Paytm savings bank. Now you decided that okay, that is closed. Let me take back that 100,000 rupees back. You do your KYC. The time you do your KYC in the bank, that income will be reported in AIS, and 2 years back data will be reported back that okay, you had a 1,000 rupees balance in that Paytm bank account which was stopped, and you did KYC for it. You had 3 rupees interest also per month, so you will have to pay, or your interest income disclosed is low. Can you please fix this? All these small things can trigger some kind of a small, we would not call it as notices, we would call it as justifications or query which is to be resolved within the ITT department, because ITT wants to make everything very perfect. So that is very important that your expert handles notices for you. Then will I have to chase them every time? No, you don't have to chase them. You get a dedicated relationship manager who will be there. You have to just write a mail to that dedicated relationship manager that I have got something like this. He will make sure that the CA is available. He gives you the support. He resolves your query. He answers those particular notifications. He resolves those particular previous ITR issues. He does all the advanced tax planning whenever you are in doubt, so that clear tax makes it very very standardized for India to get your tax expert get things done for you. Most of the time the level of 72 checks we have done through our tax experts, everyone. But if in case there is a lag in our service, we make sure there is a dedicated relationship manager who follows up with for things for you, and he makes things that it is done. So yeah, maybe you must be thinking that why do I need an year round consulting? So we have created few examples that uh, we have created few examples that how these things would help you. The last thing before we get into the examples is that uh, sharing password. These days this has become an another level of, this wouldn't have been a major issue maybe 2 years back, or at least 4 years back. Now the level of scams that are happening around, whether it is most many knowledgeable known techies have also got mugged into variable scams with respect to somebody calling as a friend, somebody being in AI. So sharing a password with anyone, and if you are having a common password across your IDD portal or something else and etc., and there is an intention of wrongdoing, it could lead to a significant amount of losses. And another thing is, many a times there is also arm twisting by multiple other agents who say that okay, you give me a password, I'll take care of everything, but every time you get a notice you are being penalized, and then there is suddenly an additional charge for solving that problem statement of notice and etc., and the password credentials lie with someone else who is not known to you, and you just hide them for one time ITR filing, which is just as good as getting stuck somewhere with your own ITR. And that's the reason ClearTax has made a platform where you do not have to share any password. By the way, it is not only about password, your contact details are also not shared with your expert, because a relationship manager does everything for you. So that your privacy is 100% maintained, your data privacy is 100% maintained on the ClearTax platform, so nobody can misuse your level of privacy, that you earn so much, your capability is so much, anyone can sell your data to any scammer or all those stuff and have some kind of partnership. So that is also very important, because these days the number of technological items that are coming up and the way the scams are happening, it's very important that the privacy is maintained. And to understand this, why the tax expert is important, we have curated few examples with very I mean, keeping in mind a very critical middle class family earning a certain amount of money and how it changes the finances of someone. That's something again our tax expert Mega will take over. Um, Over to you, Mega.
All right. Thank you. Thank you so much, Divnay. So now let us, talk about the things Divnay was saying. Of course, he did, go ahead and enumerate examples or enumerate the advantages you will have with respect to purchasing a year-long assisted filing plan, wherein we will help you give out continuous advices with respect to your taxation matter, whether it is TDS compliances, whether it is payment of advanced taxes, whether it is going ahead and doing appropriate tax planning. If there are any due dates, to go ahead and keep those due dates in mind, and to ensure that you're not on the incorrect side, or you're not on the penalizing side of the tax laws. Now let us understand with a few examples how having a good tax expert can be a game changer for you. So here is where, we've gone ahead and taken two examples. Now typically or normally you will see there are people who will say that, given the vast amount of data requirements disclosure under the old regime, the new tax regime becomes automatically more beneficial. But if you have a good tax expert, all right, by your side, the tax expert will ensure that they go ahead and do a deep dive into the old regime vis-a-vis the new regime, analyze what are all the deductions and exemptions you can claim given the expenses that you are incurring or given your investment pattern, and help you optimize your income and optimize your tax output. Now what happens if you go ahead and optimize your tax liability? What happens if you go ahead and optimize your investments? Very simple. Simply put in one line, your total monthly in hand salary increases and your TDS comes down. For example, in this case, you will see that an individual with a total earning of rupees 18 lakh after the various deductions, the statutory deduction and the monthly TDS, his net pay on a month on month basis varies in the range of 1.32 lakhs to 1.15 lakhs, depending upon the deductions and also, the bonus payout, etc. So now in this case, if you see in this example, your total earning is 18 lakh rupees and your take home or your net pay annually is rupees 16 lakhs. Now, before we do a deep dive, let us take a look at another example. Now, this is another example wherein again the total earning is rupees 18 lakh. However, the net pay is rupees 16 lakh 35,000. Example is the same, the total earnings is the same. Your basic income in both the example remains at 8.14 lakh. Your HRA is 3.25 lakh. Other allowance total up to 5.49 lakhs. Your total earning is 18 lakh. Everything remains the same, but the net pay changes. Net pay in example 1 is 16 lakh rupees. In example 2, it is 16.35 lakh. That is 16 lakh 35,000. On a month on month basis, if you go ahead and average out, or if you go ahead and spread this 35,000, it comes up to about 3,000, roughly about 3,100 per month. Now, how does a tax expert achieve it? Very simple. There could be a plethora of exemptions. There could be a plethora of deductions which you have not explored. For example, everybody, when it comes to exemptions, talks about the standard HRA exemption. But are you aware that there are certain exemptions you can also go ahead and claim under the new tax regime if you are eligible? For example, transport allowance for eligible employees or conveyance for eligible employees are certain exemptions from salary that you can go ahead and claim both under the old regime as well as the new regime. Now, going ahead and structuring your salary in such a way that you optimize these allowances, as a result of which your net pay increases to 35,000 rupees. Now, this is a very good deal. Imagine you getting that 35,000 rupees extra. Now, this 35,000, you can go ahead and reinvest this or increase your year on year SIPs, or if you're under any loan, this 35,000 rupees can go into servicing that loan. Or if you are, debt free, then it can simply enhance your lifestyle further or increase your savings for that rainy day or towards your retirement corpus. So this is why having a tax expert, a a knowledgeable tax experience by your side is very, very important. Because in today's day and age of financial influencers, flooding our social media feed, irrespective of the platform we open, it is not important to if know these common things, HRA, ATC, ATD. This is something a lot of people today know, but there are additional disclosures, or there are those minor fine print, as we say, fine print. There are these smaller provisions or the lesser known provisions of the Income Tax Act, which only a seasoned tax expert or somebody who can go ahead and dissect the law and understand can help you with. So this is one such example. All right. And again, this is a total income evaluation or simulation we've done. Now, please note that this income simulation that we have done, the 18 lakh example we discussed, this is for financial year 25-26. That is the financial year that began from 1st April 25-26. In this case, if you see under the old tax regime, the total tax payable comes up to 67,000 rupees. Under the new tax regime, it is 1 lakh 2,180. The total income is the same, 15 lakh 30,000. What were the changes? We went ahead and saw an opportunity where exemptions can increase or exemptions can be optimized, and so are the deductions. All of these by staying compliant, all right, by staying on the right side of the law, not claiming any deductions or exemptions which are unauthorized or which cannot be backed up by information, or which cannot be backed up by respective documents. So this is where having a seasoned tax experts help you save more. And why are we stressing this now? It is important now. Ever so often we see individuals make this mistake. March is the time when we rush to our friends who are tax experts, or we rush to our financial advisors, wealth managers, and ask them, give me tips, I want to save taxes, I want to optimize. Please remember, tax planning is no longer a one time event as was the norm all these years. The IT department has become so robust, the income tax changes have become so minute, so detailed, that now tax planning must be a year long exercise. You need to go ahead and review your tax statements, your tax liabilities, your tax compliances on a quarterly basis at least, to stay ahead of the curve, to go ahead and ensure that you do not lose out any additional penny on paying additional interest, on paying, advanced tax interest. Now is not the time. Only if we stay ahead of the curve, if we are always abreast with the changes, we can go ahead and cut down these minor expenditure. And please remember, although on a one month on month basis the interest that you're paying might be very small, but if you look at it on an overall basis, or if you look at it from a 12-month lens, these small amounts month on month in the form of interest become a big value at the year end. For example, in the previous example, we spoke about a 3,000 rupees additional income in hand on a month basis. Now, 3,000 a month may seem like a small amount. You may be willing to let go. But if you combine this, 35,000 seems like a big amount. Similarly, if you're paying 1,000 rupees interest month on month, you may not see the impact, but look at the larger impact. It is 12,000 per annum. Now imagine if you have the right expert by your side, one, you end up getting an additional take home salary of 35,000 per annum. In addition to that, you save rupees 12,000 in interest. If that is what you're doing, effectively, how much money do you have in hand? You have 47,000 rupees, which is a very big amount. All right. So that is why the ROI on smart tax decisions, again, is much, much more higher than your ROI on fixed deposit, which, by the way, may now come down because, again, the repo rate have decreased and also the ROI on mutual funds, which is a CAGR of approximately 12% on a year on year basis. So, yes, it is 15%. Now, how have we arrived at this 15% return? Let us understand with the help of another example. Now, this is an action plan for taxpayers who have capital gains. Let us understand how. We have taken two distinct examples of sale of capital assets. In example 1, we have taken sale of house property. In example 2, we have taken sale of shares. Now, let us say you have gone ahead and sold house worth rupees 60 lakh. The sale consideration is rupees 60 lakh. The cost of the house was 40 lakhs. So in this case, the gain is rupees 20 lakh. The capital gain tax on this gain at 12.5% comes up to rupees 4 lakhs, right? So you end up paying 4 lakh rupees here. Simultaneously, you also sell shares worth rupees at rupees 30 lakhs. So the sale consideration is rupees 30 lakhs. The cost of such shares was rupees 10 lakh. So now the gain will be 20 lakh. On this 20 lakh gain, you end up paying 2.34 lakhs. So the total taxes in this case you end up paying is 6.34 lakhs. That is 4 lakh plus 2.34 lakh. But what if I told you you can go ahead and pay zero taxes on both the capital gains incurred on the house and the shares? How is that possible? It is possible by making the right investments. There are provisions under the Income Tax Act, specifically speaking, Section 54 and 54F, which enables individuals to go ahead and claim long term capital gain exemption if they reinvest either the capital gain proceeds or the entire sale consideration to a residential house property. So, in example one, where you sold the house, if you go ahead and invest the full value of capital gains, which in this case is rupees 20 lakhs, you will not have to pay any capital gains tax at all. On the other hand, where you go ahead and sell shares or any other long term capital asset apart from a house property, if you go ahead and reinvest the entire sale proceeds, in this case it is rupees 30 lakhs, then you do not have to pay taxes at all. So, effectively, your entire 6.34 lakhs is saved in tax. So, which this 6.34 lakh savings comes up to 15.85% of the total capital gains of rupees 40 lakhs that you have made. So this is the X factor that you have, or these are the savings you go ahead and make when you have the right expert by your side. Now, while I have gone ahead and explained you in brief what these exemptions were, let me talk about them in a little detail, how you can go ahead and utilize the exemptions. First and foremost, the thumb rule is that you have to go ahead and invest either the entire amount of capital gains or the entire amount of sale consideration before the due date of filing the ITR. If you go ahead and invest, the capital gains tax will be exempt. But what if you are not able to make up your mind? What if you know you're not sure which real estate property must you invest in? Is it property A in city Y or is it property B in city Z? If you're not able to make up your mind, then you have alternative investments as well. You can go ahead and invest in rural electricity bonds or any other similar notified bonds. What if you don't also want to invest in the bonds? You're still confused. You want to explore a lot of options out there. In that case, you can still go ahead and park these funds in a separate account known as capital gains account scheme, CGAS accounts. Think of it like an escrow account. Escrow account is an account wherein you go ahead and park the funds, right? The funds which are required for a future dealing. CGA's account, so in some sorts, is like your escrow account wherein you can go ahead and park the entire capital gain proceeds or the sale consideration proceeds as the case may be. And then later on, once you have freezed in or once you have zeroed in on the residential property, you must invest in. And whether you want to purchase a ready property or whether you want to go ahead and construct a property, the funds from your CGS account can be used to make such investments. I hope this is clear. Now, quickly, let us go ahead and do a quick revision of all the capital gains on sale of land and building. First and foremost, the holding period criteria in the case of short term remains the same. In the case of short term, has been brought down. The holding period criteria for both short term and long term now is 24 months. The rates of taxes, again, if it is long term, it is 12.5%. If it is short term, it is 20%. Percent is indexation benefit available? It was available pre-budget, all right, but after budget announcement 2024, it is it is available only where the land and building has been acquired on or before 23rd July 2024. Tax rates on STCG have been increased from 15% to 20%. All right, with this, I pass on the baton once again to my colleague Divnay. Divnay will take a few minutes and then we will turn towards question. And also, given the demand that we had last time, given the sheer number of questions we had, today we have two dedicated experts from our end, from our team, all right, who are actively communicating with you on chat, who are trying to answer all your questions accurately. And at the end of the webinar, if we still have any questions unanswered, we will definitely take those questions up and answer them on a real time basis. So over to you, Divnay.
Thank you, Megha. Thank you for giving such wonderful strategies. So you must be thinking, uh, just 18 lakh salary, 35,000 rupees of savings. It's not much of a deal. If I have to put it in a way, if a particular person who is currently at 18L salary or an income, and he is able to save 3,000 rupees per month, and if a particular person invests it into a step up SIP year on year with respect to the returns, the returns could be as high as 20 lakh rupees if it is for 10 years. If it's an average CAGR of 12%, it would be 49 lakh rupees if it is 20 years. So that's a quite a huge amount, because it starts with the right planning of taxes now. And why I took an example of mutual funds, again we connected section 54 and 54F. Today you are at an 18L salary, you are able to save that 3,000 rupees, you are putting it in the mutual funds. After 10 years, you have a step up mutual fund which is coming out at 20 lakhs. With 20 lakhs, the average capital gains could be 6 lakh rupees. Imagine you put that money in, you waited for 10 years, and at the end of that, you need to pay 4 lakh rupees of capital gains. Now, after 10 years of being in job, or maybe 15 years of being in job or in a business, you decide to build your own home. And when you're building your own home, you invest that money back, you pay zero capital gains, which is 6 lakh rupees saved flat. That's the reason we took a very small example. We did not want to make exorbitantly large numbers. We wanted to make it for everyone in India. Everyone has a dream to make a home. Everyone has a dream to build their portfolio. Everyone wants to do an investment. And when there is a significant 12 to 20% of taxes being paid on those, there is a way to save it. And that's the reason we decided that we make a plan. And that's the reason we did it through a webinar, because it is very important we communicate to you. It is also very important that we get our tax experts answer your queries when you are listening to us. And the most important thing is we also make a very affordable plan that you carry this forward for all your future tax savings, tax plannings, tax filings, so that you safeguard your money, pay your due to the nation, and be a proud taxpayer at the same time tax saver. That's the reason introducing the actual Lux plan. Sorry, screen should change. Yeah, great, awesome. So you must be seeing that over the features, the cost would look 37,499. That's the MRP of this particular thing. And why this is the MRP? This is the true value of this plan. But I have to break the good news before. You wouldn't have to pay this price at all. We have already discounted and kept it as 14,999 on our website so that it's affordable to everyone, and you get an year long consulting, you get India stocks experts, you get guaranteed filing in 24 hours, you get a relationship manager who makes sure that whatever queries you have, it gets answered, whatever documents you have, he takes it. If you are not sure it is PPF transaction statement or this, that guy takes the understanding. You get any type of notices, it is taken care, and you also get a 24/7 support. But this plan is at 14,999, but only to our webinar customers. In this webinar, we have slashed it down to 9380. That's it. In 9380, you get your tax filing done, you get all your year round queries answered, you get all your documents checked by a dedicated relationship manager who tells you, okay, fine, PPF section 80C, 80D, 80G, 80CCD, 80CCD2, everything which is from NPS to all the documents which is done in 80C, which is EPFO, PPF, the life insurance, the fixed deposits, tax savings fixed deposits, what is to be done. And this is only for the webinar customers, and this offer is only valid during this webinar. That's it, because we see that this is a very, very, very interactive, understanding the customer base which understands that it is very important to do the tax filing, and this code would be valid only till 6:30, and the coupon code is save tax. And whoever has multiple source of income, is it to do with NRI, is it to do with crypto, it is to do with ESOPs, it is to do with RSUs, if you have FNO, if you have a long term capital gains, if you have short term capital gains, you have previous year notices to be solved, everything would be taken care in this plan. And you will get one dedicated relationship manager. It is to do with your current year advance tax payment, it is to do with optimizing your current year ITR filing, all are covered. And I have to tell, we just have 20 minutes. So if you are interested in this plan, either you can scan this QR code, or we are sharing the link of the same on our chat, which you can click on the link now and go ahead, which is pinned. If you could see, that is pinned on the top, the link is there on the top. You can buy this plan at 75% off till 6:30 only. Meanwhile, we will be answering all the questions you have through our tax experts, and Mega will be taking up. And if you have any questions regarding this plan, you can ask here. We can take this up here.
All right. Thank you. Thank you so much, Divne. All right. Okay. So while our experts Chandni and Pranav are already answering a lot of questions, thank you so much, folks. I will also go ahead and take up questions which have not been answered yet, or which may require a more detailed explanation to help understand